Hard truth. Wake up. Hi, I am George, and this is ChannelVest. Bitcoin is on the move at $113,899, and Fundstrat's Tom Lee says $200,000 by year-end. This is insane. Here is your acceleration lane. We stitched the whole story so you can decide faster. Why this could break old portfolios, how rate cuts, supply, and ETF flows collide, what the advanced risk math really says, and exactly where smart money is rotating now. If this helps already, subscribe and drop your pick in comments so we build this together. We will keep numbers exact, speak percent as percent, and translate finance into clean English. Sharp ratio means return per volatility. Beta means moves versus market. Expect bold hooks, but zero hype on the facts. We are about to unpack how one decision in September could ignite everything, why supply is strangled, and where the exit doors sit if things snap back. With that on the table, we pivot to the ground rules you must hear. Mandatory disclaimer. First, ChannelVest provides research only, not an advisor, broker, or fiduciary. This content is for education only and does not constitute personalized financial advice. We are not registered investment advisors. Such cryptocurrency investments carry significant risk and you may lose your entire investment. Always consult your registered financial advisor before making investment decisions. Keep that in mind as we move to the market reality that could flip the script. CQ chain reaction. The market is pricing a 97.6% chance that the Federal Reserve cuts on September 17. Tom Lee's road to 200,000 assumes crypto is very sensitive to monetary policy. Basis point means 100%. A cut can push liquidity into risk assets, weaken the dollar, and light a fuse under Bitcoin. From $113,899, the required gain is 75.6% in 112 days to hit that call. Why this matters to a U.S. investor. If liquidity rotates, classic 60-40 portfolios can lag while a small Bitcoin sleeve drives outsized swings. We just nailed the catalyst. Coming up, we pressure test performance against the benchmarks you know. A performance that hurts. The crypto market sits near $3.96 trillion, with Bitcoin dominance at 57.3%, the highest since 2021. Over the last year, Bitcoin delivered plus 125.6%, while the S&P 500 did plus 13%, nearly 10 times the pace. Over a decade, Bitcoin posted plus 33,858% versus the S&P 500 at plus 264%. Sharp ratio sits at 0.96 for Bitcoin versus 0.65 for the S&P 500, meaning better pay for volatility taken. Why it matters. Performance gaps this wide rewire asset allocation math, especially for growth seekers. That frames the scoreboard. Next, we open the hood on the September policy gamble and what each channel does to flows. Policy. Fuel lines. A rate cut can flood liquidity, soften the dollar, and pull institutions toward alternatives. Bare as all. For quick channels, liquidity floods risk assets. A weaker dollar lifts the appeal of a global store of value. Institutional appetite rises as bonds yield less, and Q4 seasonality often favors crypto and rebalancing. For investors, timing is not about predicting the meeting. It is about knowing how your Mitch reacts when policy turns. If the cut is larger, basis points stack, and the move can overshoot as fear of missing out compounds. We have the why. Let us turn to scarcity, the engine that sets the ceiling and the floor. Scarcity on overdrive. Circulating supply is 19,919,153 out of a hard cap of 21 million, meaning 95% of all Bitcoin that will ever exist is already in play. Only 1.08 million remain to be mined over the next 120 years. Long-term holders control roughly 40% and rarely sell, while dominance sits at 57.3%. Corporate treasuries are now in, tightening free float further. Why it matters. Price can move sharply when new demand meets thin supply. Carry this forward as we test what happens when Wall Street packages scarcity into mainstream wrappers. ETF superhighway built. BlackRock's Bitcoin ETF IBIT has become the fastest growing ever, surpassing $51.1 billion in AUM in under a year. BlackRock suggests up to 2% allocation for interested investors. Big banks, once skeptical, are now cautious optimists, and even firms that criticized Bitcoin let clients buy it. The holdout is Vanguard, but a price in the 150,000 to 200,000 band may force a policy shift under client pressure. ETF means exchange traded fund. Why it matters. ETF rails compress friction, normalize compliance, and unlock retirement channels. With that set, we pivot to advanced analytics that reveal how this asset truly behaves in a portfolio. Hidden correlation traps. Correlation means co-movement strength. Recent data shows Bitcoin's correlation with Ethereum near 0.67, so when Bitcoin slides, Ethereum often follows. With the SP, WBS, INX 500 correlation climbed from 0.07 to 0.21 since 2020, spiking near 0.7 in stress. Beta near 0.74 means less sensitivity than high-octane stocks, yet it still moves fast. Risk matters. A sharp near 0.96 outpaced many assets recently, but the co-movement and panics can raise drawdowns. Drawdown means peak to trough drop. Join the ChannelVest community, subscribe, and comment to shape our next deep dive. That was behavior under the hood. Up next is competition, where winners and losers shift the dominance math. Altcoin rotation. Reality. Solana crushed with plus 215.7% versus Bitcoin at plus 125.6%. Cardano holders got hit with minus 12.3% while leaders ran. Bitcoin dominance fell from 62.1% in January to 57.3% in September as roughly $200 billion rotated into other opportunities. Why it matters? Concentration risk is real. Chasing laggards or ignoring rotation can cost you seasons of returns. Keep that in your head. We compare it with the actual tail risk that Wall Street rarely says aloud. VAR worst day math. VAR means loss at confidence. At 95% confidence, a minus 12.5% daily hit is possible under normal stress. At 99%, minus 18.7% can print in extreme volatility. In a black swan, minus 28.4% in 24 hours is on the table. Monte Carlo means random scenario simulation, and it has been the only method that held up when traditional VAR failed during crypto crashes. Bitcoin now moves about 20% more than the SP 500 in stress regimes. Why it matters? You need pre-planned exits and re-entry rules, not vibes. With risk scoped, we open the hood on what the smartest allocators actually did this year. Smart money. Rotation. In Q1, hedge funds cut exposure by 32% to lock gains after 300+% runs. In Q2, advisors increased holdings by 58% for strategic allocation. In Q3, corporate treasuries accumulated 300,000 plus Bitcoin as an alternative to cash. Your projections point to $58.5 billion in total institutional holdings. The smoking gun, BlackRock, went from $0 to $217 million in Q1, while Goldman added $206 million. Why it matters? When conservative institutions buy, the risk budget conversation changes. We have the headline. The fine print lives in the scenarios that put numbers on the path ahead. 5 paths revealed. Our Monte Carlo shows a 50% base case to $135,000, a 25% path to $200,000 under perfect policy and fear of missing out conditions, a 10% moonshot to $713,000 on hyperinflation or currency crisis, and a 10% bear case to $51,430 on regulation or policy error. Expected value lands at $161,043, a 41.4% gain from here. You will not believe it, but that midline beats many stock forecasts. Why it matters? Probabilities beat predictions. That gives us the base we need to examine how to turn this into an actual decision with risk guards. Decision with guardrails. The verdict is a buy with conviction, 8.5 out of 10 based on probability-weighted math to $161,043 and an expected sharp near 0.48. Timeline markers September 17 for the initial move, October 31 when Q3 earnings show allocations, and December 31 for a 180,000 to 220,000 range test. Emergency plan. First warning at a break below $105,000. Full exit after a close below $95,000 for 3 days. Re-entry once $110,000 is reclaimed with volume. You are with ChannelVest. This is your analysis. With that clear, we pivot to what the deck flags next and how to prepare. As you subscribe and stay ahead. Follow and subscribe to stay ahead and comment your big question for our next breakdown. You are here for clear math, clean explanations, and smart frameworks that help you decide faster. Power the signal so we can keep building tools, backtests, and plain English guides that serve you. Your comment tells us what to test next and helps the community make better decisions sooner. We have the numbers. Let us turn to your final action in the wrap-up. Your next move. Here is the bottom line. Liquidity, scarcity, and adoption can flip a traditional portfolio's return mix fast. The bull path is alive, the bear path exists, and your plan is what converts uncertainty into a repeatable process. Keep your allocation size to sleep at night, set your exit and re-entry lines before you need them, and let probabilities do the heavy lifting. Stick around for our next breakdown on the model that maps Bitcoin's response to policy shocks. Hit subscribe, drop a comment, and we will see you in the next breakdown. Goodbye and take care.